Just about a month back, there was this news about a 150 crore prop trading scam. The story begins in Surat, at a firm called Greenwall Enterprises. Though the boards on the wall said Janam Stockbroking. They had a proper office with dozens of traders who would swipe in every morning, log into terminals that looked straight out of an institutional dealing room. This wasn't retail trading as usual. This was a different world. Special limits and leverage that your regular broker wouldn't even dream of offering. At the center of the web was a man called Darshan DJ Joshi, moving crores of rupees from traders across Delhi NCR, Jaipur, Ranchi, Kolhapur and beyond into a structure that promised something magical. 7x margins, no questions asked. Bring 10 lakhs and trade with 70 lakhs. For a while that magic worked, until one random morning in August when the terminals simply froze. Positions couldn't be squared off, calls went unanswered. The key men behind Greenwall had vanished. And slowly a brutal truth emerged. A lot of this money had never actually touched the regulated broking system in the way traders assumed. It was floating in side pockets, dummy accounts and private arrangements that lived in the shadows. As investigators dug deeper, they didn't just find one scammy setup, they found an entire underground ecosystem built around misusing proprietary trading accounts. Prop terminals that were supposed to be used only for a broker's own money were quietly opened up to outsiders in exchange for deposits, commissions and profit shares. On paper, many of these traders were shown as employees. In reality, they were customers. So in this episode, I'll ask a few bigger questions. What is prop trading actually supposed to be in India? What's legit and what's not? And most importantly, how do you spot the difference between a real prop opportunity and a scam? I'm your host Sandeep Rao and today we are going inside the world of prop trading to understand how it works or rather how it's actually supposed to work. With that, let's get started. Like I always do, let's start with the origin story. Before electronic markets, trading in India happened on crowded exchange floors like Bombay Stock Exchange. Two key players ran the show, brokers and jobbers. Jobbers didn't have clients. They stood on the floor, constantly quoting buy and sell prices for certain stocks and made money from the small difference between those prices. This helped keep trades smooth and prices active because they were always ready to buy or sell. They were market makers, so to speak. Back then, proprietary trading mainly meant brokers and jobbers betting with their own money. Rules were weak, transparency was low, and some brokers formed operator groups to push prices up or down. Big scams came from this kind of speculative prop trading. Harshad Mehta in 1992 and later Ketan Parekh around 2001 used huge amounts of borrowed or misused funds to drive up stock prices until the whole thing collapsed. These episodes show how dangerous unchecked prop trading could be when the market and regulations were still immature. By early 2000s, things changed for proprietary trading in India. Between 2000 and 2002, NSE launched index futures, options and single stock derivatives. This gave prop traders new tools to speculate, hedge and do arbitrage. Broking firms built big arbitrage desks to profit from tiny price gaps between cash and futures or between NSE and BSE. At the peak, some brokers had hundreds of in-house traders. A skilled arbitrager could make tens of thousands of rupees in minutes after market opens or even a few lakhs on a volatile day. By mid-2000s, roughly 30,000 people were working as prop traders or arbitrage traders. Around the same time, standalone prop firms started to appear. Experienced traders left brokerages to trade only the firm's own capital, often in derivatives or niche segments. Global proprietary firms and funds also began looking at Indian markets, entering mainly through FII/FPI routes. Domestic quant and algo-focused firms like ST Advisors in 2008 and iRage in 2009 were early signs of the coming HFT wave. Lastly, regulations also caught up. Settlement moved to T+2, risk controls improved, and exchanges were demutualized to reduce conflicts of interest. SEBI made brokers clearly mark trades as client or pro, so that proprietary activity could be tracked and abuses like front-running were easier to spot. But what exactly is prop trading supposed to be? Well, proprietary trading or prop trading is when a firm trades with its own money for its own profit, not on behalf of clients. The firm, a broker, bank or trading company, puts its own capital. It trades stocks, futures, options, commodities, etc. All profits and losses belong to the firm's own book and there are no customers or clients. The goal is to make a direct profit for the firm itself rather than earning commissions by trading on behalf of clients. This means the firm takes on 100% of the risk and in turn keeps 100% of the profits. In India, there are primarily 4 categories of prop trading firms. First, brokerage firms. Many large and small brokerages have dedicated proprietary trading desks where they trade their own capital. Second are banks. Both private and public sector banks engage in proprietary trading, often in debt and currency markets. Third are dedicated prop firms. These are private companies or LLPs set only to trade the firm's own capital and the capital of its partners or directors. They do not handle client funds. Lastly, we have HFTs or high-frequency trading firms. These are specialized type of prop firms that use complex algorithms and high-speed technology to execute a vast number of trades in fractions of a second. So how does one set up a prop trading firm? Many large prop trading firms take NSE Alpha membership, which is a low-cost membership designed exclusively for prop trading. But even though it's considered low cost, it doesn't mean it's cheap. Let me give you an idea of how much it would cost you if you were to take an NSE Alpha membership. To trade both equity and F&O as an Alpha member, you need to place about 45 lakhs as an interest-free security deposit with the exchange, pay a one-time membership fee of around 5 lakhs and then pay annual charges for different segments. On top of that, you have setup costs for accounts and compliance and recurring expenses every year for things like trading platforms, back office software, CAs, and compliance work and clearing member charges. Even with a very minimal setup using NSE's free Now Trading platform, the running cost, excluding deposits, can easily be 4 to 5 lakhs per year. If you want to do algorithmic trading as an Alpha member, the expenses increase further. You cannot rely on the free Now platform for proper algos. You need to own your own execution systems, APIs, servers, lease lines and data feeds plus extra compliance work. That can push annual technology and infra costs to 10 to 12 lakh range or more. On top of this, there is an opportunity cost of locking up 45 lakhs in deposit that earns no interest. If you assume a 7% return elsewhere, that is another 3 lakh per year in foregone income. Put together, the hurdle you must clear in saved costs or extra profits is easily upwards of 8 lakhs per year just to break even. Importantly, an Alpha member does not get any special margin or leverage benefit. The margin rules are the same as for a normal retail trader. You still have to meet the span and exposure requirements as per exchange norms. So you are not getting extra leverage, you are mainly getting direct exchange access and control over your infrastructure and processes. Because of all this, it only starts to make sense if the brokerage you are currently paying is far higher than these new fixed and opportunity costs, and if you are planning to operate at something close to an institutional scale, managing hundreds of crores. Also, you cannot set up a company for trading. If you want to, you need to register as an NBFC. The truly low-cost option is to just register a partnership firm and avoid NBFC or SEBI registration requirements. But the problem is, in a partnership, all partners carry unlimited liability. In trading, where losses can theoretically be unlimited, that makes a partnership firm a poor structure for investors. Lastly, how do you know if a prop trading firm is legit? In India, the term proprietary trading or prop trading is often misused to trick retail traders. In a real prop firm, you are hired as an employee or a consultant to trade their capital, just like any other job. The moment they ask you for your money, it's almost certainly a scam or an illegal sub-broker setup. Big red flags include any security deposit to unlock trading limits. A genuine prop firm never does this. Crazy leverage like 10x, 20x, training fees before giving you a funded account, only profit share with no base pay, and a vague legal structure where they can't clearly show whether they are a broker, NBFC or LLP with proper SEBI registration. If you are paying to trade, you are not a prop trader. You are just a customer in a risky, likely illegal setup. In short, the only real prop trading opportunity is to get a job with legit prop desks in banks, brokers or global prop desks operating out of India. Everything else you hear about is some form of a scam. But here's something interesting. I'm sure all of you have heard about the fact that more than 95% of retail traders lose money. But that's not the story with prop trading firms. Based on the financial year 24 SEBI report on retail derivatives trading, which also mentioned the prop category, the data is striking. It mentions 2 categories of prop trading firms and their profits. 1. Domestic proprietary traders made a gross profit of 33,000 crores before transaction costs. 2. FPI propters grossed 28,000 crores in profits. They also stated that 96% of proprietary traders' profits in F&O segment came from algorithmic trading. The data confirms that prop traders, unlike the vast majority of retail traders, are highly successful in the derivative segment primarily due to their use of high-speed, systematic, algorithmic strategies, HFT, arbitrage, market making, which requires immense capital and technology. Interesting, right? So that brings us to the end of this deep dive on prop trading in India. I hope you found this episode valuable. Do share your questions, thoughts, and feedback in the comments. I'll do my best to respond. Thank you for watching and see you in the next one.